So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions. Welcome to the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way for you to exit your highly appreciated asset. I'm your host, Brett Swarts. In each episode, I am joined by some of the best financial, wealth, business, and real estate minds in the world, where they share their ideas, deal stories, and inspiration, so together we can make complex tax deferral strategies simple and passive income plans achievable. We're also streaming an expert CRE secrets as well, so it's kind of a dual podcast here. And I'm excited about our next guest. He's a repeat guest. In fact, this is, I believe, his third time on the show, and I like to call him a Hall of Famer when it comes to all things investing and all things wealth. In fact, he's the founder and CEO of Untitled Capital Management. He has over 30 years of investment experience, and he has worked with many of the largest and most sophisticated institutional and private investors in the investment strategy, portfolio management, and asset allocation world. At the end of 2008, he retired as the executive vice president with PIMCO to rejoin the UC Irvine School of Business as an adjunct professor of finance. And then he also decided to launch Untitled Capital as well. We're excited to bring back David Young to the show. Hey, David, how you doing?
Doing great, Brett. Thanks for having me back.
Absolutely. Good to see you on the restream that we're streaming here live on YouTube and Facebook and such. And so let's start with your story for our listeners. Give us a bit about your story and your current focus.
I will happily do so. And then maybe afterwards or now, you tell me. I am reminded by our compliance department that I need to read this compliance disclosure.
Sure.
Brett, you want me to do that now, or shall we?
Now is great. Let's knock it out.
Now is great. Okay. I was going to offer a dramatic reading. I thought, we could kind of jazz it up a little bit, but I'm not sure I could really pull it off. So let's just give you a straight up efficient reading. Pardon me if I have to read while we go. So Untitled Capital Management, LLC is a registered investment advisor with the SEC. Registration as an investment advisor does not imply a certain level of skill or training, and no inference to the contrary should be made. This interview is for informational purposes only and does not constitute investment advice, an offer to sell, or a solicitation to an offer to buy any securities. Ooh, that was a mouthful. While many of the thoughts expressed in this podcast are stated in a factual manner, the discussion reflects only Untitled Capital's beliefs about the financial markets in which it invests portfolio assets at this time and may change at any time. The descriptions I make are in summary form, are incomplete, and do not include all the information necessary to evaluate any investment. Prospective investors are referred to our Form ADV Part 2A for a more detailed discussion of risk factors, which can be found on the SEC's Investment Advisor Public Disclosure website, and it's http://investmentadvisorinfo.sec.gov, or provided upon request.
Excellent. Thank you so much, David. And so now let's dive right into the interview. Give our listeners a little bit more about your story, please, if you could, and your current focus.
Sure, will. Happy to. The story is simple. At least it seems simple when you look back in time. It didn't seem all that simple at the time. I often say that if someone had told me 10 or 15 or 20 years ago that, I would end up here and we would end up here doing what we're doing and working with great people like Brett and working on, doing a podcast and working on, with clients who, Deferred Sales Trust and other tax minimization strategies as well as just general investment strategies, I would have said no way. But long story short, started off a number of years back out of undergraduate, actually at Rockwell International. So we're going way back, but we'll do it fast. And that was an aerospace contractor. Many of you would know that name. And it was aerospace and defense contracting. It was pretty dry. That was during the bull market of the 80s, which many of you will not remember. That's a good thing. And that was go, go, go. And so I went and joined Smith, Barney, Harris, and Upham. Venerable old name on Wall Street, was there for a while. And then after that went on to business school and had found my niche. I really enjoyed it. Business school, then a CFA, which is a Chartered Financial Analyst designation. That's sort of the credential of choice in our business. Drafted then to go over to PIMCO, Pacific Investment Management Company, both here in the US and then many years overseas in London and Munich offices, mostly London. Where I headed the group there. And it's just been a great wild ride. Came back to the US sort of 06, 07, 08 after many years overseas and saw an opportunity to, spin off from that very large, very good investment management firm. And it's kind of, almost a dream, right? If you were at a point in your career when you knew what you wanted to do, you had the opportunity and you had the means to do only the parts of your day that you wanted to do. Right? We're all like, I really like talking to clients. I really like, whatever. And I have to do all this other stuff because my boss tells me I have to. Well, we said, I have an idea. Let's go. Let's step out of PIMCO. Very fond memories, great firm. And let's see if we can make a business out of doing only the things we really enjoy doing. And one of those things is what you and I are doing right now. And the rest is kind of history. We manage money for endowments, foundations, deferred sales trusts. The list goes on. And these markets are crazy, but we're having a good time.
And that's a great segue, right? Because a lot of our clients, they're faced with highly appreciated assets, right? That they want to transition into the next phase of their life, right? They want to be done with the toilets trash liability. They want to maybe retire from their business or even launch a new business. I mean, we just did a deal in Alabama for a gentleman who sold a business, and he's in his 40s. He's young. He's like, hey, I want to go launch my next business. And he was able to use defer the tax and use the funds to be able to go launch another multifamily investment business. It's remarkable when you focus on what's most enjoyable, what's your highest and best use. I believe we've all been given certain gifts, and these gifts are been given to us to be a blessing. But if we are, at times in certain circumstances with either job, work, businesses, sometimes we can, as things grow and get bigger, we can lose track of that, or our energy has to go focus on other things. So if you can sell something, defer tax, and use that as a vehicle to launch your next thing, or maybe use the gifts that you want to be giving or traveling or whatever it might be. Freedom is the key here, right? So we like helping people escape feeling trapped by capital gains tax. That being said, it's kind of a long-winded way to introduce this question. Would you help our listeners understand your journey to the Deferred Sales Trust? What were your thoughts when you first heard about it? Take us to day one, and take us to also maybe even 30 years of this, because I'm sure there's a lot of day ones with certain strategies that have come around, and you say no to those for whatever reasons, and then walk us through why you said yes to the Deferred Sales Trust.
Yeah. So, we're first and foremost, we're economists, we're money managers. We spend all day watching markets, looking at, Bloomberg screens and debating whether or not, the Fed's going to raise interest rates. They elected today not to, which was not a surprise. I think the market's going to do that hard work for them. And I think Fed Chairperson Powell and the rest of the Fed knows that. And fortunately, over the career, had an opportunity to work with a couple of the current Federal Reserve presidents. And so I have some sense of how that body thinks. But specific to the capital gains tax, what did I think? I thought deja vu, oil and gas limited partnerships. I thought windmills in out in the California desert. Right over our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had I honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. And I still don't think I'm an expert. Not that it's that complicated, but its power is to a degree in its flexibility. And so it's sort of like every time I'm like, that's a slightly different. That's a different setting, different context, different opportunity, different challenge. And so it almost feels like even though the ground is very sort of well worn, at least in the way estate planning team and this Deferred Sales Trust is operated, that it seems like that there's just still new information all the time, and that's good. Yeah. Long story short. We got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
Got it. That great introduction to that. So the 2-year time period. Yeah, getting to know the visionary, the founder, co-founder of the Deferred Sales Trust, Robert Binkley, and then the tax attorney who started this as well. I think there was, I didn't, correct me if I'm wrong, but there was flights to meet with the tax attorney, maybe a day or two, I don't know, spending looking at the boxes and where things go, and at the end of it, I think it was, I don't know if I heard the quote right, David, but it was, that might be the smartest person we've ever met, right? I don't know to put words in your mouth, but talk us through just how you came to the conclusion of, okay, or take us to the moment where like, okay, this thing works, we like it, we want to move the relationship forward, if you will.
Mm-hmm. Yeah, I think it was probably 3 things coming together. There was a flight out to Lake of the Ozarks, Missouri. And I remember it because I used to do a lot of business in the great state of Missouri, and had been, to the lake a number of times. And that was a couple of day event that was quite intensive. Todd Campbell Law is the tax attorney you're referencing. Obviously, very impressive person, in my opinion. And again, from my estimation, which is all I can speak from, he knew every answer to every question without hesitation, but importantly, was able to put it in such a clear and succinct manner that you knew he understood it at the very essence. Sometimes, and money managers are the worst, right? We go into what I call the mumbo jumbo, and it's the Greek letters, and the Sortino ratio, and okay, what exactly? It's like too much sauce on food. Like, what exactly are you trying to hide in there, right? Anyway, and so those were enlightening, or sort of revelation sort of moments. And then I think I'm seeing the first one go from idea through the process and understanding, and I had an occasion to do this this was maybe 18 months ago, right? Start to finish, and just watching it as it unfolded and developed was also very helpful. And then separate to all of that, talking to someone that I knew, and I didn't even know this person was working with the Deferred Sales Trust. It's a college buddy of mine who lives in the area, and then chatting with him about his experience. And so I got to see it from the technical aspect, the practical application, and then the user's aspect. This person was selling a highly appreciated home right here in the area, and it was just enlightening to see his take on it. And so those 3 things all came together.
Excellent. Thanks for sharing. And so, yeah, by the way, you can go to capitalgainstaxsolutions.com to learn more about the Deferred Sales Trust. And if you're a client who's already listening to this, we love to bring David on because, by the way, he can help. He's an option to help manage the funds. That's part of what his team does. And our goal here at Capital Gains Tax Solutions and also the estate planning team, the goal is aligned with both organizations to try to provide what's called a dream team. We want to bring some of the best wealth advisors and real estate ideas and try to help you create and preserve more wealth. And that the Deferred Sales Trust is the tool, and the team helps to execute all of this. So you can go to capitalgainstaxsolutions.com. That being said, okay, so you went from 2-year due diligence, you see the technical, you see the practical, you see the application with the user who's selling a high-end primary home in Southern California, and now fast forward, I don't know, maybe that's a year or two ago now. I'm not sure quite on the time frame of all of that, but why is the Deferred Sales Trust so important or so powerful right now for high net worth individuals selling assets that are highly appreciated?
So what would I say? I would say, number one, taxes aren't going down. I think we can all probably agree on that. Some might debate that, but I can tell you as an economist and a market watcher and someone who, reads policy statements from, administration, state, federal, see the amount of debt being issued. We see it all. And I think taxes aren't going down. So if anybody were waiting for a better tax environment to sell, be it stocks or a house or a collection of cars or whatever life happens to bestow on you, that strategy is probably not going to bear fruit. Yeah. Number one. Number two, I think diversification is important. It's always important. I think it's more important now. Here's what we've seen, especially in environments where there's so much liquidity and just money sloshing around. Certain parts of the market, we're seeing them get very sort of, overstressed. Other parts, there's still a lot of opportunities out there. The real estate market is strong. Prices are up. That's good. I do always laugh sometimes in the stock market. Clients will say, well, I do want to reposition my portfolio and get more diversified. But I have a lot of, gains. I have a lot of capital gains in these stocks. And I don't want to pay all those capital gains taxes. So now this is specific to the stock market. So I want to wait for the stock prices to come down. So you made a lot of money. And rather than pay a little bit, we could argue maybe more than you should, that's for another day, to the government, you want to wait till you give back some of your gains to the market. This is not a good strategy. So I think diversification is always important now, maybe more so than ever. Those two things I think come together most powerfully. And then I think this ability, as I said before, to get liquidity, as it turns out, as we discovered back in 2007-8 during the great financial crisis and the aftermath. We discovered it again in a very cold water splash in the face in March, April, and May of last year. Remember where we were right around this time last year, right? The wheels were coming off and liquidity was king. And we always underestimate the value of liquidity until we need it and don't have it. So here's a way to get that liquidity, get that diversification. And then the last part I mentioned before, I got ahead of myself as I sometimes do, time horizon, right? Is to then say, now we can put this money in an instrument and, for this 10-year period. And then of course it can be extended. It can basically be rolled over after that. Buy ourselves the most important part, which is control, transparency, diversification, and the ability to move that money around based on what's happening in the world, be it inflation coming back, interest rates going up, stock market going down. All these things are coming. I just don't know exactly when or in what order. But the Deferred Sales Trust allows us this insulator to do all that, maximize return before taxes, and let the investor, let the client decide when they want to realize how much of those various proceeds. It's very powerful.
It is powerful, which leads us to the next question, which is this: it seems like it's too good to be true, David. My CPA would have heard about this, right? Why hasn't someone else told me about it? Why isn't everyone doing it? And so I don't know if you've heard that yet. I hear it about every day, but what would be your response to that?
And it's usually got an element of sort of not distrust or sort of, oh, hold on now, wait a minute now, and so it's the two edges of the sword that come with wanting to protect something. In order to protect something, anything, a great business idea, intellectual property with a patent, a transaction type, which in this case has certain legal and other protections, so that no one importantly can take the really good idea and go basically duplicate it. That's important. But more importantly, take the good idea and mess it up. Mm-hmm. So in a strange way, when you are protecting anything, right, it also places some limitations on its broad use. Not everybody can see it or access it. It's not perfectly transparent or out floating around on the internet. We expect everything to be Googleable, right? Well, this isn't Googleable, at least not in terms of the detail, because there's no way to do that and make it that broadly available without protecting it to make sure it stays, it's done right. Look, we have this conversation about the asset portfolio, where the nature of it is that the investments must perform within a range. And the range is fairly generous and there's some flexibility. But the point is, all of the parts, the legal structure, the tax elements, deferment elements, and the investment elements, they all have to work together in harmony, and they all have to perform. If any one of them breaks, then we have a problem, and it's my reputation, and it's your reputation, it's Bob Binkley's reputation, and these are serious folks. I think of myself as a fairly serious person, so my entire life developing my credibility and my reputation, and I'm not about to throw it away. So, in a strange way, the activity of protecting that
Mm-hmm.
sanctity results in the fact that it isn't as widely known as you otherwise think it might be. That's actually a good thing.
Right, it is actually a good thing, right? And it's why it's been 25 years now plus, thousands of closes, billions under management, over a dozen no change successful IRS audits, and because it's just an installment sale, right? Now we're created with a third party unrelated trustee, which is what the services we provide here at Capital Gains Tax Solutions. But it takes a team of professionals to execute this in a way that maintains the law of IRC 453. And that's important to mention. By the way, we also think and believe and would hope to think that just the same fact that you can diversify the wealth, the IRS also says that could think and would believe that you're going to diversify the taxes being paid, right? Because this is truly deferral. This isn't avoidance, right? What we're saying is they're actually locking in the gain, versus the 1031 exchange where it's, right as it stands right now, it's kind of, you can drop into your swap or swap into your drop. And in 2008, when things were not diversified, and if you're trading one single asset for another single asset, taking on a bunch of debt, guess what? Things can stop, and all of a sudden that gain gets wiped out. And guess who else who doesn't get the tax on that? The IRS. Whereas in the Deferred Sales Trust, we're taking that gain and we're kind of locking it in and we're preserving it, right? And we're going to spread it across potentially 100 different investments in 100 different companies, right? From different countries, different areas, different. It can be real estate, it can be stocks, right? It could be hard money lending, it can be a number of things, and therefore it increases the chances of when you receive payment, you'll pay tax. Also, by the way, it gets new property taxes, right? Because the property sells. The agent gets the listing. He has to pay tax on the commission. So it's actually a win-win-win. So would you dispel maybe where folks think it's not a win? And any thoughts on that, on David with the IRS?
Well, I want to make sure I'm answering the right questions. So, folks who, I haven't had a lot of people who come to the conclusion that it's not a win-win as you described, and as we've both described. Probably because I'm a little bit further down that food chain, right? So if they're not seriously interested in having overcome many of those, initial concerns, we've talked about a few, which are all pretty easily dispelled, I believe, then I don't have a lot of interaction with them. They never kind of get far enough down the path for me to talk to them about, okay, now what do we do with the assets? Yep. I can tell you in the ones I've been engaged with, I've got nothing but, happy clients. I don't want to over answer the question.
Yeah, no, that's exactly right. And which leads to the next one. like, what is the deferred sales trust? It seems too complicated, right? It's too good to be true. Okay, we figured out the legal, it's proven, it's done. Okay, but the next thing is, but it's just too complicated for me or my advisors to understand.
Mhm.
My counter to that, I'm curious what you think, David. It's, well, they haven't done it yet, or their clients haven't done it yet until someone's done it that they know. And kind of like your story, right? Where you said you had the technical part of it, you had the practical part of it, and then you had the application with a friend of yours, right? And you're saying, okay, all three, and that helps to solidify that. And you can't also beat them up too much, because sometimes they're calling us with 30 days to go, right? And this is a $10 million business sale. All of a sudden they're looked up and they're like, oh my gosh, I'm going to have a $4 million tax liability. Oh my gosh. And it's such an emotional big thing. And they go, I don't understand everything over there, so I'm just going to either A, not do it, or acquiesce to what my CPA says, who's never seen it either. So just walk through and try to put us, if you're in their shoes, David, right? Not trying to take us out of it. Being in the industry, 15 years, you're 30 years. Take us out of it and help the client right now who's looking at this and saying, I just don't fully get it. How do I know I can trust that I'm going to be okay?
So let's see. And Brett, I'll ask you to chime in here a little bit too. We can kind of tag team on this one. It's funny. Someone, at least in terms of conceptually, compared and contrasted a deferred sales trust with either a basic IRA or a self-directed IRA, where someone might elect to purchase a piece of real estate in your IRA, which you can do. There's such a thing as a real estate IRA, right? And it's just like the other one, except it's buy real estate in there. And now there it's different because it would be an initial purchase, or you'd be investing in something that hadn't appreciated yet. But if you forget about that part, right? What is it really? It's an IRS tax code, just like 401k and the IRA tax codes, right? There's a bunch of them, right? Which basically says that if you're investing money or owning an asset for these set of purposes, which we believe to be, good, retirement, whatever the case might be, right? There's some elements of kind of the tax code wanting to incent, the right kinds of behavior. And you open up this particular type of an account and it's conforming, right? It's got to meet these different rules and regulations. That if you put an asset in there, you could buy one share of stock or whatever, put an asset in this instrument, it will grow tax qualified. In that case, we say tax deferred, right? Until such time. And there's some other conditions about age, which aren't part of this. That's because that's a retirement, right, vehicle, whereby you can defer payment of taxes. When you turn a certain age or choose to take it out, there might be a penalty if you take it out. It's really not different. It's if you keep it super, super, super simple, the only difference is here, rather than putting $1,000 in an IRA and then going out and buying some stock or some bonds, and then we start this whole journey, right? Here you're putting in something you already own. And then there's a note that comes back representing your ownership. There's a trustee overseeing it, right? There's all these different parties who are in place to manage it and make sure it does what it's supposed to do. It's really fundamentally no different. And so when you boil it down to its simplest comparative wrapper, something like an IRA, which we're all very familiar with, most of us are very familiar with, I think you demystify it.
Very well said. Yeah, I couldn't say it any better. Couldn't agree with you more. And this will be the last one here on the deferred sales trust, and then we'll shift a little bit to what's going on with this. How does this bull market end, if it does end, and touch on Jay Powell's announcement to not raise interest rates for the foreseeable future. We'll touch on that here in a minute. So this is the last one. Is the DST is just too expensive with the ongoing fees, David. Or I guess maybe it could even be for wealth managers like yourself, right? Your fees, they're so expensive. And so I'll give an example. Someone's selling we just did a deal in the Santa Cruz area. It was a $7.9 million sale, and they had about $2.6 million of liability of tax. So they paid off debt, by the way, of about $2 million, and they put about $6 million or so into the trust and deferred the 2.6. And they go, how can you charge, this? And that deal, I think it's somewhere around 1.3 or 1.4% on an annual basis, recurring, and the setup fee is about 1.5% of the sales price. You have a little bit of a break over $1 million. But that being said, give us from the fee of the forest or the tree versus the forest, right? And how would you if someone's in the shoes right now thinking it's too expensive, what would be your response to that?
I think here's what I would do is I would take a step back and think about the expenses related. I would do three things. I would do what we call basically a holding period return analysis. So one investment says, if I understood you properly, you make the transaction, you defer 2.6 million in taxes, you're left with 6 million, right? And then I would say, well, what are 2.6 million in taxes deferred as a function of the initial sale amount, right? That percent, divide by 10. Assume a 10-year holding period. We can all do that math, right? Do that right now. So that's going to be a number. And I would compare that number to the original initial setup fees, right? I think you mentioned maybe is it 1.5% setup, right? Okay, divide that by 10, because even though you pay it up front, the reality is it's buying you this 10-year long transaction. Divide that by 10, goodness gracious, that's like a fraction, that's 15 basis points. It's very little in the grand scheme of things. And then I would add that to your annual running costs to manage the money and have the trustee oversight and all that. I think when you compare those, I think you will find out that the break-even rate, right? The amount of time it takes you with some reasonable rate of return, whereby the upfront fees to set up the trust plus the running fees over that break-even period of time compared as a percent to the taxes you saved spread out over time, your break-evens look like a couple of years, not even. I mean, and then after that, you could argue, right? I'm not saying it's free, but you could argue all the time after that break even where expenses cross tax savings, that's free. The trust and the transaction is in effect free to you, the investor. And so that's the way I would look at it. I don't think you can say, I would have to write a check for this for legal and a check for that for accounting and then pay ongoing management fees and trustee fees. You have to pick a period, make it 5 years. 10 years is the normal trust period, and just do that very simple back of the envelope math. It doesn't have to be rocket scientist. Don't worry about compounding of interest and all that. Just do simple straight line arithmetic. And I think you'll find that break even is really very early on in this transaction type, and the rest is you could argue gravy.
Beautiful. Let me see if I can encapsulate that. And that was just so articulate and so well said. And I love the way you broke that down. So you take the liability, let's say 2.6 million, and you divide that by the price, right? The 7.9 million, or the asset sales price. Or even in this scenario too, I would also maybe wonder if you do it by the net proceeds, because they're going to pay off about $2 million of debt, so let's just put it at 6, and you divide that by 10, that gives you a number. And then you're going to take the 1.5%, let's say that's the number, and you divide that by 10, and you go, okay, that's about 15 basis points. Let's assume a 10-year period of time. And then we're going to do the plus the annual running cost. And at a certain point, you're gonna contrast those two versus just paying the tax, and you're gonna get a break even rate where essentially you say, okay, this 2.6 that I would have paid, I'm earning interest on this net of the recurring running cost fees, and it breaks even at 2 or 3 years, and then after that, it's all free or it's no longer costing me, right? My return on my investment on this, if you will, is now infinite returns. Is that a fair summary?
Yeah, fair summary. A couple of things, caveats. So whether or not you do the 2.6 in tax savings on the original sale amount or the base, that could be debated. You could do it both ways. It wouldn't take long. It's just a pencil and a calculator or Excel. You would want to assume some rate of return for the monies that you didn't pay on taxes, but in fact invested, right? Here's the very simple point. Just in a simple snapshot, assume you have an extra 2.6 million. Cut right to the heart of the matter. You would have had the other money anyway, so assume marginal only. Assume you have 2.6 million more than you would have because you didn't spend that on taxes. Now, 2.6 million, taking into account, call it 1.5% per year. That's on 2.6 million. You're talking. Yeah, I can't do the math in my head, unfortunately, very quickly, but you could assume that 2.6 million earns, something very conservative, 5% a year. I think we could all figure out that, 5% on the 2.6 million savings is clearly more than what all these other, what the other startup and running fees are on the total amount. Right. That's kind of the break-even analysis.
Excellent. Very well said. And for those who want a full analysis, you can go to capitalgainstaxsolutions.com and we can customize that for you. By the way, we don't charge anything for anything unless and if you close the deal. And this the deal actually closes. So it's no cost, no obligation, due diligence period. All that being said, now let's shift to part of this episode now, which has to do with how does this bull market end, we're now recording this March the 17th, 2021. Jay Powell came out today and essentially, and correct me if I'm wrong, said that there's no in the foreseeable future raising of the interest rates. Of course, it could change. Things can change, but he doesn't anticipate that. First of all, give us that summary, confirm that for us, and then let's chat about what are some key indicators that you'll be looking at to gauge that things are staying healthy as they can be, David.
Sure, quite a lot to unpack there, and as you might imagine, entire shows are made up. If you watch CNBC, at the end of the day, it's one show after another talking about these types of things. So let's see if we can't boil it down into simple terms. Context and history always matters, and so here's what I would say. If we're asked, how does an economic expansion eventually, kind of roll over and turn into a slow period and then ultimately a recession? How does a rising stock market, we'll just call that a bull market in assets, risk assets, eventually sort of slow down and then retreat as is the cycle? It's never exactly quite the same every time, and that's because the preconditions that started that economic expansion or that bull market in assets are never exactly the same. They can't be. It's just not possible. So if we want to know where we are in the cycle, and most importantly, so we can try and figure out how much further, it has to go, we have to spend a minute and figure out how we got here. And I'm not going to go into a big, economic and market history lesson, except to say we still to this day have material remnants of the great financial crisis of 2006, 7, 8, really. And that is a condition of a tremendous amount of liquidity, excess liquidity, I would argue, with inflated central bank balance sheets, because right around that time they stopped being pure referees and started being combatants. Imagine central bankers taking off their striped jersey and donning the jersey of maybe the jersey of one team and the helmet of another, running onto the field. It changes everything. And even the rules started to change a little bit. And so that was a really important period. Well, that's still with us today. You have a very active Federal Reserve in the markets more than ever before. You have this overhang of liquidity from 10, 11, 12 years back, something like that, more. And then you have COVID, which is a pile more fiscal activity, right? Spending by the government, more activity by the Treasury, more activity by the central bank, all of the kind of, the authorities in this game that's being played, combined with a tremendous amount of liquidity being pumped into the system. And that liquidity was the right thing to do. We had to shore up asset markets and credit markets and the consumer and small businesses. And now we have the $1.9 trillion additional stimulus package. I'm generally in favor of these measures. Only time will tell if it's too much. But funny thing about medicine, if it's too much, you can probably deal with that problem. If it's not enough, you have a whole different problem, which is the patient doesn't get better. The patient actually gets sicker, right? And so that's something we're going to be watching. But so the run-up, that 10, 12, 13, 14-year period of how we got here matters a great deal and affects how this ends. And we're watching, and the end is not near. Don't worry. We're watching 7 or 8 different factors to give us a sense of when both the economic expansion and for people listening in here too, and for the Deferred Sales Trust investors, when the bull market in assets might end.
Let's focus on maybe 1 or 2 that you feel are the most crucial out of the 7 or 8.
Mm-hmm. Sure thing. Well, see, in my business, maybe like many businesses, you develop these age-old adages. I mean, how exactly old they are, I don't really know, but they're old enough to be called age-old adages, and and there are a couple that I firmly believe in. Number 1, economic expansions don't turn into recessions of their own length or breadth or magnitude. It's not like there's some magic tipping point that says, and you'll hear people say, well, there's 22 consecutive quarters of growth. That would actually be quite a long run, right? Of growth. And that's the longest it's ever been in the post-war and blah, blah, blah. That doesn't matter. Every one of these is different. Right. And as soon as you set a record, you better believe that you're just setting a basis on which to set another record. That's how the world and life works. So, we don't spend a lot of time looking at the length and breadth of economic expansions to try and determine when they end. What I can tell you is they end usually because of one main reason, and that is central bank or banks. We'll just pick on the Federal Reserve because we're here in the U.S., raising interest rates too far, too fast. And basically, maybe it was to pump the brakes to slow economic expansion. They hit them a little bit too hard. The economy slows, more abruptly and dips into recession. And then sometimes it's the follow-on knock-on effects that makes that worse, right? And you get a really serious recession. The Fed does not plan to create really serious recessions. But this is also like trying to steer a very big thing without all the tools you certainly might want in a perfect world. And so that's first and foremost. There are other kinds of causes to an end of recession, of an expansion. The beginning of a recession. We used to have one listed as number 7, way down at the bottom, and it was global pandemic. And people went, global pandemic? That's silly. Global pandemic. That's never going to happen. Oh, wait a minute. It just did. So, and why do we talk about the end of economic expansions and the reasons why they end? And the number one cause being the central bank raising interest rates, is because the age-old adage says that bull markets in stocks, right? The stock market going up, NASDAQ going up, all these Dow going up, S&P going up, also doesn't just run out of steam and end, right? What ends up happening is something stops them, and usually what stops them is a recession. So watching what is probably going to bring an abrupt end to this, or at least an end to this bull market, is really a lot about watching what's happening in the environment in which the stock market operates, right? It operates inside of a global and a U.S. economy. So those two things are attached at the hip. They're not the same, but they're attached at the hip. So with that backdrop, you could probably guess the first couple things that we're looking at, but I'd be happy to summarize them for you, Brett.
Please do.
Yeah. So, and we'll break this down by what's green. What's green right now, meaning we're not worried about it, meaning it looks fine. But if one of these 3 things were to turn yellow or red, we would start to get worried fast. Number 1, the expansion appears well entrenched with a lot of good forward momentum, no recession in sight. We just talked about the importance of recessions in this whole scheme of things, number 1. Number 2, there is very little sign, if any, in fact, quite the contrary. There's confirmatory and affirmatory statements even today by Chairperson Powell that the Federal Reserve is not planning on hiking interest rates at any point in the kind of foreseeable or actionable future, right? That was not a surprise. We expect the Federal Reserve and other central banks to leave this liquidity in the system to keep kind of trying to fuel economic growth and COVID recovery in all the different forms it takes. And so that's a bright green indicator, no problem there. So what do I think is going to really matter this time? There's a few, but a change in investor sentiment. Right now, investor sentiment is green. You see it every day. In fact, so green, it's like flashing neon, sparkly, bedazzled green. It's really green, right? Everything is a reason to buy. Everything is a reason to buy the dip. Oh, I just got hammered in my whatever. Well, I'm going to buy more. I mean, that's the only solution. You buy more, right? Well, that isn't always the case. Ultimately, or at some point in time, investor sentiment will shift. And rather than buying those dips, which would obviously help, keep a market up, people will turn to selling those dips, and it can turn very quickly. So we're going to watch for things that might change investor sentiment from buying the dips to selling the dips. And for us, that's things like asset valuations getting very high. It's things like recession we talked about. It really has to do with things that affect the U.S. consumer psyche, unemployment, and other such things could very quickly just backwash right into the consumer, who is the investor's sentiment. Remember, the economy is made up of people, and the markets are made up of people. Those are the things we're watching. But right now, our dashboard's, largely green. A few indicators are flashing a little bit of yellow. Nothing is really red to speak of, except some of the frothy behavior around certain individual stocks and parts of the economy. So we think 2021 is going to be a good year for returns.
Amazing, David. I mean, yeah, a whole dissertation, a couple books right there. And I want to just thank you for being on the show. We have run out of time. We've covered so much. For our listeners or clients or people who are looking at the Deferred Sales Trust, they want to find out more about you, David. Would you give them the best website or the best way to connect with you?
Yes, we are very simple. It's just Anfield. And I always get this wrong. Are we Anfield Capital or Anfield Group? I don't even know my own website. It's embarrassing. Or it's AnfieldCapital.com.
Yep, AnfieldCapital.com. I'm looking at it right here.
Yeah, we have more than one, but I want to make sure you give it the best.
So you get paid the big bucks, not to get all the websites, right? You get paid the big bucks to analyze all of the numbers in the marketplaces, right? So yeah, you can find more about David Young, CEO of Anfield Capital, at AnfieldCapital.com, and I'm going to put that here right now on the below the show notes here. So AnfieldCapital.com. And if you want to learn more about the Deferred Sales Trust, you can learn more at capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. And that being said, David, I want to thank you again for being on the show, sharing a bit about your story, giving us so much wisdom, helping us to overcome false beliefs with the Deferred Sales Trust, giving us tangible indicators to take a peek at, keep an eye on. Right now, it's staying green. We're like for most stuff, but it certainly is a time to be aware of what's going on. And these are the type of podcasts we like to produce, so you have some good content to think about. Okay, so that being said, I want to thank everyone for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy such as the Deferred Sales Trust, and hiring and bringing on groups like Anfield Capital, especially if you're a financial advisor, by the way, I forgot to mention this. They help financial advisors, they're money managers for financial advisors. That's typically the flow of how Anfield Capital works. Is the best way to grow your business, help your clients, grow your wealth. With that being said, thanks again for watching or listening. We appreciate everybody. Bye.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.